Welcome back to the Hunter of Dividends YouTube channel. Appreciate everybody being here again, seeing the numbers going up little by little, and I certainly appreciate that. I'm here to talk about what I think are 3 recession-proof dividend stocks. I don't know if a recession's coming right away. I know there will be another recession. We all know that. It's just a matter of time. So if you think there's a recession coming at any point, what kind of stocks should you be looking for? If you're here, you probably like dividend stocks. I certainly hope you do. If not, I encourage you to look into dividend stocks more because it's great passive income. It also encourages you to be less active, have more of a boring investment type, and that actually has proven to be long-term better for most people. Less emotions involved, more compounding of money. And we love that. So let time and compounding work for you. Let's look at 3 stocks that I think are good recession-proof stocks. First is Verizon. I'm going to take a real quick look through these. I know your time is valuable, so I'll try to move quickly through these. Verizon, the 1-year chart here, got as low as $45. I was buying it quite a bit at that point. Kind of wish I had bought even more because of when I look at their long term, I just think that was too low of valuation. 5-year chart, this has been chopping in between at 45 and 60 or so for a really long time now. So Verizon has been in the same area. Here's Simply Safe Dividends. As I say every time, this is a tremendous service. So if you don't have it already, I do recommend it a lot. The beta 0.29, very low volatility. This stock does not move very much. The dividend yield of 5.04%, a dividend safety score of 87. That's tremendous for a yield of north of 5%, certainly. Payout ratio of 47%. As we can see here, the forward PE ratio, 9.3 compared to a 5-year average of 11.7. The communications sector, 16 overall. Payout ratio staying well below what their preference would be for telecoms. The free cash flow has been a little bit wacky based on some of their movements and their expenses here of late. In general, though, it hasn't been too high. Earnings per share have gradually gone up slowly. Shares outstanding staying about the same. Now they've had good ROE and operating margin. There is plenty of debt here. A lot of it is leveraged at a low fixed rate. So keep that in mind. Verizon here on fast graphs, as I try to move quickly through this and show you what it's looking like. This is looking undervalued at this point. You see the PE ratio far below its average. Let's look on cash flow. I like looking at the cash flow. Certainly, it's still below both of these trend lines as well. And if we forecast this out in the future, this would estimate total annual return somewhere in the middle would be a 31% rate of return, 27% out several years. I don't know about you guys, but I'd love to have a 27% rate of return. We'll see if it comes to fruition, but I do think this is a good price here for Verizon right now, as you see well below many of these markers, trading at a blended PE of just 9.7. So I think Verizon, one thing I forgot to mention too here on the Simply Safe Dividends page, look at how it did before. Recession sales, negative 1.2%. Recession return only negative 38% when the S&P was down 55%. Look, people still spend on cell phones. Telecoms are not going to get hit hard when there is a recession. We all know that Verizon's still going to get paid. So I think that's a good one. The second one here that I like is Kimberly-Clark, ticker symbol KMB. Kimberly-Clark is a bit of a different story in that I don't know that it's as cheap as Verizon is right now on an operating basis when you look at their estimates. But I do like this stock for the long term. I think it's a very safe name, 3.53% dividend. Let's pull up Kimberly-Clark here on Simply Safe Dividends. Kimberly-Clark, 88 dividend safety score, which is really impressive. 0.10 beta, which is about as low as you get. So this one doesn't move very much either. Forward payout ratio, to me, would suggest that you shouldn't expect very much growth from Kimberly-Clark in this dividend. 74 and 80% payout ratio, and the free cash flow hit 89%. So I think they'll be able to continue to keep paying the dividend they have now, but I would not expect a lot of growth here. So if you're mainly a dividend growth investor, you might not like this one as much. inflation and supply chain has definitely hit their earnings per share. I expect this to bounce back long term. This is a business that's very safe. If we look at the recession sales here, -4%, so very safe. When you have hygiene products, look at Cottonelle, Scott, Huggies, things like that. I mean, people are still buying that regardless, and that will be the case in the future as well. If you look at Kimberly-Clark's return, it was -34%. The S&P down 55%. The CAGR is 4% over the last 5 years, just 1.8% last one. Like I said, I don't think they'll be growing very quickly. Let's check out Kimberly-Clark quickly here on fast graphs under historical first. This looks pretty close to fairly valued, maybe a bit overvalued, if anything, if you're just looking at valuations on this one. And then free cash flow for Kimberly-Clark, staying around the average here right now. If you look at the forecasting it out, long-term growth, this looks a little bit overvalued. So, you can choose whether you think this is a good one to get into now. I'm certainly not an investment advisor. Looking at estimates here, long-term, this may not be a great price to get it at. Maybe you want to see if this one dips some. I don't think this one has been beaten down to the point of some of the others. So I do think Kimberly-Clark's a very safe company, and I like having it in my portfolio. Great for recessions. The question is whether now is a great entry point or not. And the last one, guys, I have to talk about Johnson & Johnson. This is my biggest holding in my portfolio. I've owned some of Johnson & Johnson since I was in high school. I wish I had been more committed to actually getting into the stock market more when I was in my 20s. So if you are young, I certainly encourage you to do it even more. But I started when I was 16, 17 years old, and then kind of lost interest for a while, and then I've been back into it in my 30s. But Johnson & Johnson here, 176.42. This one is higher in its range. This is not really sold off very much. You can check out the max chart there. This is a stock I loved at Johnson & Johnson. I think it's a very good stock. 2.56% dividend yield, 6.6% dividend growth, a beta of just 0.28. Check out 59 years in a row, by the way, of dividend growth. That's tremendous. 17 in the PE ratio, which seems a bit high. I love their earnings payout ratio only being 43%. The free cash flow has been about 52, 56%. There is room for growth here for Johnson & Johnson. They will continue to grow this dividend. I'm very confident of that, regardless of what happens here in the economy. Look at the earnings per share here. Very impressive. Just consistently going up. They had one down year just a bit there in 2020. Free cash flow per share has come up really nicely. Return on equity is great. Net debt, really, really low. Interest coverage is amazing. This is a very well-run company. The balance sheet is fantastic. Its credit rating would tell you that, certainly. So I really like Johnson & Johnson a lot long-term. I think it's a tremendous stock, great company. Fast graphs here, we'll look at the historical numbers. The blue line here is its normal PE. It's right about the normal PE range. So I'm not really looking over or undervalued from that. Free cash flow range, it's a bit over its average valuation. If we look at sales, this one, we don't have a blue line here. But in general, it may be a bit overvalued, if anything, right now. Having said that, let's forecast out in the future, look at estimates. This is trading a bit higher on this end as well for diluted earnings, free cash flow, looking about that way as well. I do think that Johnson & Johnson is going to trade at a premium to the market in general. It has to. It's too good of a company to not trade at a premium. So I would say that Johnson & Johnson, you don't want to wait around to see a really low PE on Johnson & Johnson because it's just not going to happen. So I'm not buying more Johnson & Johnson right now, but if this thing were to dip in the 160s again, I'm happy to buy some more. 150 certainly would be buying more again. I think J&J is a tremendous recession-proof name, and I will go back here and look at the recession sales were -6%. The recession return -27%, which was excellent, where the S&P was down 55%. payout ratio being so low. I think this is a great one. So my 3 recession-proof stocks that I like a lot: Verizon, Kimberly-Clark, and Johnson & Johnson. If you have any that you think are great recession-proof stocks, definitely drop those in the comments below. I'd love to hear what your thoughts are. Do you think there's going to be a recession soon or not? And then what do you think of these three stocks, or any of these ones that are on your radar for buying anytime soon? If you would, give this a thumbs up, subscribe to the channel. I appreciate it very much. Follow me at Hunt Dividends on Twitter. I hope everybody has a great week, and we'll be talking about some more dividend stocks again soon. So we'll see you next time.